And now, time for some general webinar rules. Although the attendees won't be allowed to turn on their mics during the presentation, but just in case of any glitch, we request you to put your mics on mute. Try to ask new questions and try avoiding already discussed topics. A very good afternoon to one and all present here. Android Club presents to you Revelation, a 3 days fun-filled fest with events spreading its wings across immensely helpful tech talks to soul-soothing musical night and an event filled with laughter. Our today's event is Stock Mania.
After watching Scam 1992, we all want a bada dhamaka in our lives, like Harshad Mehta, right? But stock market isn't something which one should proceed with without proper guidance. Where should I invest as a beginner? Should I buy IPOs in this ongoing IPO season? How to do a fundamental analysis of a company? Should I start with mutual funds? These are the questions which usually hit our brains while we start our investment journey. And to sort all these doubts of yours, we have with us stock market wizard, or as we say in India, market guru, Mr. Akash Jain. Good morning, sir. Now, I would love to introduce this very knowledgeable and amazing personality to our viewers. Currently, a full time public market investor, Mr. Jain did his BE from NIT Jaipur and his PG diploma in management from IIM Ahmedabad. He has spent 11 years in private equity with various firms, including Creador, People Capital, and ICICI Venture. And this brilliant career started as an investment banker with Edelweiss.
I would like to extend our heartiest welcome to our speaker, Mr. Akash Jain. And now, without further ado, we will turn over the time to him. So you may please proceed.
Thank you. Thanks for the introduction and warm words you said. I think I am very far away from what you said in terms of market wizard or investment guru. I think to some extent my background has been covered. See, other than the fact that I have been in investing for the last 15 years, I worked for about 12 years in private equity investing. And now for the last 3 years, I've been a full-time investor in the public markets. Even after 15 years in the markets, I can very categorically tell you that I don't understand anything, to be honest. And every year there is something new to learn. And people who have spent 30 years in the market also are learning every year. So you will never be able to say that I have learned enough, because the market every year teaches you something. So I think that's the most important mindset that everyone needs to carry with them in the markets. Probably to some extent with everything in life, but I think especially with investing, because things there are new things every year to learn and unlearn as well. Okay, so Shraddha gave me a little bit of a background in terms of what you guys are looking for. To be honest, in a 45-minute presentation, I can't teach you finance and I can't teach you investing. Even after 20 years, I still don't know what investing is, to completely be honest with you. But what I'll do is, assuming that you guys are still very, very taking early baby steps in this field, I have tried to cover some basic stuff, and then from there you will have to build on yourself. No one can really teach you everything. So I'll give you some help you start baby steps in this journey. Okay. So a standard disclaimer: I am not an advisor. I am not registered or licensed to give any investment advice. I am not talking about any stock in this presentation. But you do your own work. I am not licensed or even competent enough to give you any stock market advice. So I think very, very basic stuff, that why should you invest? See, the point is, you will make money when you get in your job. You'll start earning salaries, and then all of you will have your expenses. You will have some EMIs from your education loan, maybe your expenses of rent and all the partying that you will do and all. But there is going to be some savings, and I think savings is very important. Why are savings important? Because I think three main things events in life, right? Either they are medical issues, or maybe God forbid there is a problem with your job. You always to help you in if there are unforeseen events. Second is, if you have some savings, it can also help you take calculated risk in life, you want to take a 1 year or 2 year break to do something that you really want to, or you want to join a startup or start a startup, that gives you a cushion that, okay, let me take a bit of a risk because I have some money, and if it doesn't work out, I can go back to what I was doing earlier. And I think the most important thing in my view is basically over a period of time, it will lead you to financial freedom. And when I say financial freedom, it will lead you to a place where you will not need to work only for money, and you can then decide to work for what you want to work for or enjoy what you want to do. So the other thing is, one is you save, and then the other important part is you should also look at growing those savings. So if you save 20,000 rupees once you get into a job, then you should look at how you will grow the 20,000 rupees, and the next year you will try to save 30,000 rupees, and you will every time grow. And the main reason to grow that money is obviously the above three things that we discussed, and the other thing is you want to beat inflation. Now, I think, what is inflation? Like, inflation is practically something which you see all around you, right? So every year fuel prices will go up. It has been happening. The garments, the clothes you wear, every year you will see 5-6% increase in there. Your rent goes up by about 5% every year. So what is going to happen is, whatever you can buy for 100 rupees now, in 1 year time, you will only be able to buy the same thing for maybe 105 or 106. So if your 100 of saving remains 100 of saving, next year, the value of that 100 rupee declines, because what you can buy for 100 rupees today, you will be able to buy lesser amount next year, because there is going to be a general price rise in the economy. Now, the way it is calculated is basically there is a basket that the authorities assume is the normal basket, right? For example, Abhishek or Shraddha, they will assume that, okay, they will have a basket where they will spend 20% on rent, and then some amount on fuel and some amount on food, etc. And based on the price rise of each of them, a composite inflation number is indicated. Now, the basket for Abhishek can be different from a basket for Shraddha, can be different for a basket of Akash, right? But it gives you a broad sense of where the economy and the price rise in the economy is going. You may feel more pinch, I may feel less pinch, depending on how we are consuming different products. But ultimately, it gives you a sense of where economies, the prices in the economy are going. And 5 to 7% has been the inflation every year on a broad level. But if you ask me, most of you will start feeling that based on your basket, probably the increase in cost of living every year will be almost 10% for all of us. So you need to save, and you need to grow those savings so that you can beat inflation, right? Because what you have today will be 10% weaker next year if that savings has not grown up by 10%, and again your salary has to grow and beat inflation. Right? The other thing that is very important is this whole thing of CAGR, or compounded annual growth rate. Albert Einstein has called this the eighth wonder of the world. See, I think what is important to understand is, you see this mutual fund ad of Rohit Sharma and Shreya Iyer, right? And he says, timing the market is not as important as time in the market. And I think that is basically the whole concept of compounded annual growth rate. Where if you look at the graph very simply, if you have invested 100 rupees at t is equal to 0, for today we start with the 100 rupees, me, Abhishek and Shraddha, okay? Shraddha makes 5% over 20 years. Abhishek makes 10% over 20 years, and Akash Jain makes 15% over 20 years. See, after 20 years, what is that 100 rupees value difference is? And that difference becomes pronounced as time goes by, because what is happening is that 100 becomes 175, and then you make 15% return on that 175. You're not making that 100% return, 15% return on 100. So as time goes by and you are able to maintain a higher rate of return on your savings, the amount that you will end up with deep into the future becomes very substantial. And that is where the beauty of compounding lies, that you will not feel in 4 years time, look at the graph, in 4 year time the differential is not so much, right? It's 175, 146 and 122. But see what happens as time goes by. So what is really important from any investor point of view is that you start as early as possible, right? Because you get more time. So time is one factor to reach your financial goals. So you start at 20, 25 rather than starting at 45. And it doesn't matter what amount you start with. You start with something. The second thing is obviously higher the amount, higher is the end number. So if you ask me, you should all focus on getting good jobs, doing very well with your jobs, earning well. Hopefully, economy is in a good shape. You will all get good jobs, and also save as much as you can. Obviously, don't save by not doing the other fun things important in life. But I think it's important to also keep an eye on savings and keep an eye on where to invest those savings, right? And the third important part is obviously the rate, like 5% versus 10% and 15%. So logically, everyone will think that let us try and get the maximum amount of out of this, right? But there is no free lunches in life, right? This 15% return comes with its own issues. It is not an easy path. Okay, even if it looks like 15% over 20 years, you will really need to live through those 20 years. And I'll take you through some of the things that you can expect if you want to invest in equities or other more riskier asset classes. Okay. So broadly, I think this probably most of you will have a sense of, but if you broadly look at the basket, right, there is obviously small things like gold and all that stuff, but if you pick up the three biggest asset allocation for any household, it is basically fixed income. Where I say fixed income is nothing like loan, you put FDs or you buy government securities, you buy corporate bonds, RBI bonds, SBI bonds, right? It is called fixed income because they will give you a fixed rate of return every year. So when a bank, SBI, FD tells you that I will pay you 5.5% in a year, after 1 year, they will pay you 5.5%. Simple. They tell you an amount, there is no volatility, no risk, nothing. And most of the time, you will also, if you need it, you can go and break your FD and you get the money next day. So that's the rate you get for what is called the risk-free rate, right? Where there is no risk to the outcome. The second thing is equities. Equities over a period of time has given 14 to 15% return over a longer period of time. You can invest in stocks, you can invest in ETFs, which I'll take you through, and mutual funds. But the point is that this 15% is over a long period of time. But over a 5-year period, over a 3-year period, you can actually have negative returns. So this is not a smooth path. This is not fixed income, right? So this higher returns comes at a cost, and that cost is volatility. Then there is real estate. Real estate is very illiquid. Normally, I will not advise any of you to buy real estate to start off with, because if you buy a house very early, you will basically spend a maximum part of your life or large part of your life paying EMIs. And you will put almost all your capital into one house, and that is also illiquid. So in my view, real estate, because it's a large chunky investment at one go, probably at a very young age, at least my advice or my personal opinion is that real estate should not be done very early. Once you have some corpus, you can put something in real estate, but think of real estate more as a consumption item. You want to own a house because you want a certain quality of life, but I am not a big believer of real estate as an investment vehicle. I think this is important. Just take some time to look at the chart. Basically what it says is all these asset classes, right? Gold, real estate, corporate bonds, T-bills are basically government securities, T-bills and G-Secs. And then there is this large cap, mid cap, and small cap, which are basically equity stocks, right? Large cap means large stocks like Reliance and HDFC Bank. Mid cap are medium-sized companies, and small cap are smaller-sized companies. What is important to see is that if you look at 2011, gold gave 30% return in that calendar year, right? And then you look at 13, 14, and 15, gold was minus 18, 2, and minus 8. Okay. Look at small cap, just an example. In 2011, it was the worst in terms of returns, minus 36%, right? And look at next year, it was 36% positive. Then minus 10% in 2013. So the key point is, don't think that there is going to be a one-way street in any asset class you invest in. There is always going to be ups and downs. Even in something like gold, there will be volatility of returns. So one important thing is you have to understand that there is going to be volatility. That is a part of life. And the other thing you have to understand is you can't put all your eggs in one basket. Right? You will have to have some portion of your investment in debt as well, because you need liquidity for various purposes, right? You want some money in the bank, for example, if you need to buy something or there is some emergency, there is some amount, maybe 2 or 3 months or 6 months of expenses you need in the bank, either as FDs or savings bank account. maybe some small portion in gold, maybe, I don't know, and equities. So there has to be a combination, and you need to know that if this year has been a great year for equities, you have to understand that next few years will not be so. It is never a one-way street anywhere. I think Shraddha had asked me to cover what is a stock index. So everyone keeps talking about Nifty and Sensex, right? What is Nifty and what is Sensex? So basically, see, there are some 6,000 companies listed in the market, in Indian market, right? There is a Reliance, and there is also a company which is like very, very small, hardly trades, right? So if someone wants to talk about what is happening in the market, you can't talk about 6,000 stocks. So what happens is there are different indices which are created, which is basically just a combination or a weighted average of those individual stocks on which that indices is made from. For example, the Nifty 50 is the most common index that everyone talks about. Nifty 50 is basically made up of 50 stocks with different weightages. So Reliance has the highest weightage, then there's TCS and Infosys and HDFC Bank, ICICI Bank, Axis. So practically the largest 50 companies in India, and that basically a ratio of their combination is basically what makes the Nifty. And so what happens is any day a Reliance may go up or HDFC Bank may go down, right? So within those 50 stocks, some stocks will go up, some stocks will go down. But you use Nifty as a rough indicator of which direction the market is going. And I think that's very important because it gives you a broad sense. So there is something like a Nifty 50. Then there is something called a Nifty 500, which is an index made up of the first top 500 stocks in India. It is a more broader index than Nifty 50. You also have something called NSE mid cap and small caps, and then you also have sector indices, right? You have a Nifty Bank, you have a Nifty IT. So Nifty CNX IT is basically index made up of only IT companies. So you will see some days that Sensex is up or Nifty is up and IT stocks are down, and that day you will see that CNX IT will be down because it is made up of IT stocks only. It's important because it's an indicator, it's a marker that you can use to understand what is the general direction of the market, right? So this is, if you look at the journey of Sensex, right, from 1980 to now where Sensex is upwards of like 60,000. The journey has been great. People have made a lot of money, a lot of wealth has been created. And there has also been a lot of falls during that journey. And whenever there is some big thing that happens, either it's like a Harshad Mehta scam that the moderator was talking about, right? 1992 scam, and that led to a huge liquidation of the market, right? Market fell like anything. But again, it went up because the economy picks up, and at some point in time, more investors come in. Then what happened in COVID, right? We all have lived through COVID last year, where markets fell by like 40%. And then you see what happened after that. So the direction in the long run has been very strong. Broadly, if you ask me, if the economy is growing by say 6-7% and there is a 4-5% inflation, then nominal GDP, basically the economy grows up by 10-12%, you can assume that equity markets to some extent will grow at slightly more than that. So that is why when I say long-term returns in the market are almost like 14-15%, that is where it's broadly coming from. Okay. So Warren Buffett said something which I was telling you when I started my presentation as well, that investing is simple but not easy. And why? Simple because if you look the long term, you think that you will make good money, right? But if you look at the journey, it is not easy. So it's simple but not easy. So if you believe that you can't handle a 20% or 25% decline in your portfolio at any point in time, I think you should never be in stocks. There will be umpteen number of times, almost every year or every second year, there is going to be a scenario where your stocks will be down 20%. So today your portfolio is 100 rupees, it will become 80, and then it will start from there. If you mentally can't prepare yourself that you will see significant drawdowns and significant downward loss or mark to market on your portfolio, you should not be in stocks. You should not be. Okay. So what happens is in the bull market, right? Since April 2020, market has only gone one way. It has only been one way, and I think it has happened only once in the last 20 years where Market has just gone one way without any correction. But that is not the norm. The norm is that every year there is going to be some minor correction, and every 7-8 years there is going to be a big correction. And when market is going only one way, where all stocks are going up, everything looks easy, right? You put money in any stock, you will make money. Very simple. But the problem is when this correction or crashes happen, that is when you start realizing the other side of the coin, right? Which is the pain of investing in stocks. So there have been many instances. Many stocks are corrected by 60 to 80%. 60 to 80% correction in a stock. That happened in 2001, when the US tech bubble crashed. In 2008, you guys were probably too young for it, but 2008 there was a financial crisis. Lehman went bust and all that stuff. That also led to significant correction, almost 60% correction in most of the stocks and indices. And even in 2020 COVID, right, the market went down by 40% and most of the stocks went down by 50-60%. So you have seen 3 crashes. I have seen 3 crashes in my lifetime. You probably would have seen at least 1 or 2. Even in normal circumstances, there will be scenarios where some companies will just fall by 90%. Right? You had PC Jewelers, Manpasand, Jet Airways, DHFL, Yes Bank. The market was not crashing, but these guys stocks crashed. There are a lot of companies which will have fraudulent financial numbers. And when these frauds come out, like what happened in the case of Satyam or what happened in the case of Yes Bank and DHFL, these stocks will just crash. So volatility and losses and taking significant pain in your portfolio is a part of investing. You can't run away from it. And right now, for the last 1.5 years, probably you guys have not seen it, but I can bet you it will happen. And it will happen, and then you will learn, and then you will realize. I think the big part of investing is some basic knowledge. I don't think you need to be, over a period of time, most of us will learn the basics of investing. I don't think it requires too much of technical understanding. You spend some time, keep learning, and you will learn. I don't think anyone needs to do a C or an MBA to learn and do stocks. You need a lot of hard luck. Like luck is a part of life. Everything you do, there is an element of luck. I think the element of luck in investing is even more than in general in life, right? There is a lot of hard work if you want to do well in investing, because you have to follow companies, you have to read about a lot of companies, track results, see what is happening in the market, understand economy, everything. But I think most important is it requires very strong mental fortitude. And when I say mental fortitude, when everything around you is going up, when Zomato and Nykaa are listing at those kind of valuations, you need to understand whether this is froth and euphoria, and when do you start to take a step back and start thinking whether where is this going, right? Also, when there is severe correction like that happened in COVID, how do you react to that kind of crashes? I think this is very important. And I think generally risk management, how do you risk manage your portfolio is very important. So I think everything is important, but I think to me the most important thing in investing has been how you are able to mentally keep sanity and how you are able to mentally adjust to different scenarios in the market. So just to give you an example, this is on a log chart, just to give you an extent of what kind of because if I don't use a log chart, this thing will not come out. You guys are engineers, you will understand what log charts are. So Nasdaq, which is basically made up of all tech companies, top tech companies in the US, it had a 75% decline in 2000. The Nasdaq, the index declined by 75%. Okay, in 2008, it declined by 50%. Don't forget this. You will think today that this will not happen. It has happened. You look at Nifty 50, our 50 top stocks. 2000 Nifty declined by 50%. 2008 Nifty declined by 60%, and even in 2020 Nifty declined by almost 40%. We talk about Amazon and the kind of value Amazon has created and $2 trillion market cap, etc. Not many people will know that Amazon stock had declined by 90%. So if you had 100 rupees invested in Amazon, that 100 rupees became 10 rupees in 2000. 10 rupees. Okay, it looks very easy now. It declined by 60% again in 2008. Then I was talking about some of these stocks, right? PC Jeweler, decline of almost 90%. Yes Bank, 90% plus decline. Reliance Power, 90% plus decline. Then this Tech Solution, Chennai-based IT company, right? Their stock is also declined big time. So, see, I can't teach you basics of finance. What I'm trying to tell you in this slide very simply is to some extent explain to you how you should look at businesses. Very, very simple example, right? The simple example I could think of is you want to go and buy a grocery shop. So you basically go and buy a grocery shop. You upfront have to pay 50,000 rupees, 50 lakh rupees for the grocery shop. And then you spend some 10 lakh rupees for refurbishing, putting shelves, putting an AC, putting a refrigerator for milk and curd and all such stuff. So 60 lakhs is what you invested in the business, 50 plus 10. That 60 lakhs is your capital that you have put from your savings. That is the capital of the business. Okay. Now you have to obviously buy stuff to sell. So you have to buy rice, wheat, pulses, curd, milk, etc. So you have to you decide that I'll take a loan of 10 lakhs because I've already put in 60 lakhs of my own capital. So you say, okay, I will take 10 lakh rupees of loan, and for this 10 lakh rupees, I will buy all the stuff that I need to put in the store to sell. And what happens is that let's take a very simplistic example where this 10 lakh rupees worth of stuff you sell every month for 12 lakh rupees. So what is going to happen is every day, broadly, you will sell 40,000 rupees product, right? 12 lakhs divided by 30. So like 40,000 rupees every day you will sell. And you are basically, the cost for you is about 30,000 rupees, 33,000 rupees every day, about 10 lakh rupees a month. You guys are with me, right? It is clear, I'm assuming, right? And then what will happen is you obviously have to incur some costs because you will probably have to hire a couple of guys and you have to pay electricity bill, etc., which is probably, let's assume it costs you 1 lakh per month. And then all your friends are in jobs and they will come and say, we don't have money. So you decide, okay, for these friends, all my friends can pay after 7 days. So whatever today Shraddha buys from my shop, I will give 7, she can pay me after 7 days. Okay. And then you go to all the suppliers and basically from people you are buying wheat and rice and all, and you say, I will pay you 15 days. So I will get money in 7 days, I will pay you in 15 days. Now, very broadly, if I start looking at what happens when you look at your business after and at the end of the year. At the end of the year, the income that you will make from that business is 12 lakh rupees into 12 months, which is 144 lakh rupees. That's the income for the full year from that shop. Okay. What you have spent in buying what you are selling directly is 10 lakh rupees that you buy rice, wheat, and pulses, right? And 12 times that is 120 lakhs. So what is your gross margin? Gross margin is basically 144 minus 120. So what you are buying to sell and what you are selling. That is your gross margin. Very simple. 24 lakh rupees your gross margin. Then obviously you are incurring the cost of electricity, of people that you are hiring, etc. So your cost is about 12 lakhs and the profit you make before taxes is 12 rupees. And then at the end of the year, Nirmala Sitharaman comes and says, boss, you have made money, you have to give me tax. So you give 25 rupees, 25,000, 25% tax and you pay 4 lakh rupees of tax. So what you end up at the end of the year is 8 lakh rupees of profit. Very simple. Now, if you look at the other side, you have invested 60 lakh rupees in the business, like 50 to buy the shop and 10 lakh to refurbish it. That is your capital. Then you have debt of 10 lakh rupees. What you have bought with that initial capital, which for example is your land, building, ACs, plant and machinery, etc., is something called fixed assets. In this case, you have bought that shop for 50 lakhs, which is nothing but a shop, a physical building or a shop in the building, and then 10 lakh rupees of furniture and fixture that you have put in. So this is basically fixed asset of 60 lakhs. Inventory is nothing but what you are keeping in the shop to sell. So you are keeping, at any point in time, you are keeping 10 lakh rupees worth of stuff in the shop. So that is the inventory. Payable is what you have to pay. So you have bought rice pulses. I told you earlier that you have asked for 15 days credit. So what is payable is what you have to pay, what you have already taken and you have to pay them. So you have to pay, you get 15 days of credit. So if you have to pay 10 lakh rupees every month because you are getting 15-day credit, at any point in time, you will always have 5 lakh rupees that you have to pay. You buy 10 lakh rupees, after 15 days, you have to pay 5 lakh rupees. And then that 5 lakh rupees just continues. So you always have a credit of 5 lakh rupees for you. On the other side is receivables. when your friends have bought stuff, you have given them 7 days of time to pay. So if your daily sales are about 40,000 and you're given 7 days, so almost 3 lakh is what you will need to get from your friends. That is basically receivables. Very simple way to look at the business. And what is your return on equity? Your return on equity is nothing but the profit you made on the total amount you invested from your pocket. So you made 8 lakh rupees profit every year, and then you invested 60 lakh rupees from your pocket. So you are making almost 13.5% of ROE, or return on your capital. Okay. Now, how should one think of stocks? You have to think of stocks simply like you are running your own shop, right? Think of it as an owner, right? So if any business makes higher profit, that business is better. A business that makes 2 lakh rupees profit a year versus a business that making 10 lakh rupees of profit a year, obviously the 10 lakh business is better. Then some business that does not require you to put in that 60 lakh capital, and you can make the same profit by investing 30 lakhs capital. Logically, that's a better business, right? If your business is such that you don't have to put, you don't have very high receivables, right? You don't, if your friends come and say, okay, now we are in great jobs, we don't need any 7-day credit, we'll pay you straight away. Then your business become better because you get money, not in 7 days, you get money straight away, right? You are storing 1 month of inventory or 1 month of goods in your shop. If you are able to have a system where you are buying every 7 days and rolling over that stuff, right, your inventory comes down. That's also a better business, because once your inventory comes down, to that extent, you will take lesser capital and less debt. Okay, very simple. Now, if your guys who supply you rice and pulses, they are very happy and they say, oh, you are doing such a great job. Instead of paying us in 15 days, you pay us in 30 days. Again, very good for you. Very good, because it saves capital. You will have to invest less capital in the business. Any business which is 20% ROE is better than the business that makes 5% ROE over a period of time. So very simple things, right? You look of every business. These are the simple things that you have to understand. Then apart from this, if a business is growing strongly, tomorrow that shop is doing so well that you buy another shop. Sure, that's better business than business that is not growing. A stable business, for example, every day you are selling 40,000 rupees from that shop, versus where there is one day there is 40,000, second day there is 10,000, third day there is 60,000. So the sales are very volatile. You don't know what is going to happen, right? That is not as good a business as a business where sales are very predictable. So you can use common sense to understand what is a good business and what is a not so good business. But every business has a value. A not so good business also has a value. A good business also has a value. And obviously the good business has a higher value than a not so good business. Now, when you look at stocks, you have to think of yourself as part ownership, because it is what it is, right? You are partial. When you buy shares of Reliance, you become a part owner of Reliance. Obviously, you are a very, very small owner of the company, but you become an owner of the company. So what typically will happen is, when you initially buy that shop, you will use your own earnings and your capital. So I will be the owner of that shop. Okay, then the business does very well, and I want to buy another shop. So I will buy another shop. Then I want to buy another shop. Then I realize I don't have that much capital. So what I will do is, I will go to my friends and family. Okay. So my friends will say, okay, I will give you this much and you give me this much stake in the company. So I will give a stake in my company. I will own 80%, give 20% of the shares to my friend and take money from him. After a point in time, I will say that, okay, let me do an IPO. When I say I let me do an IPO is, I will go and take money from the public. Okay, then in which case, then ownership becomes distributed, right? Everyone can become an owner of that company. So at the time of IPO, you apply, you become a shareholder of the company. And once the stock starts trading, when Abhishek sells stake to his shares to Shraddha, or I buy it from XYZ, the ownership keeps changing. But when you buy stocks, you are buying ownership in that company. And that is why you need to understand what is the quality of the business in which you are buying stake in that, because that is where you have to understand the business. Then only you will know it's a good business or a bad business, and you will also know at what price and at value you are buying that business at. I think one rookie mistake a lot of people do is, you look at the stock price. The stock price is not important. It's completely useless number. Okay, so Nykaa at 2,000 rupees or a Reliance at 2,500 rupees doesn't matter. That number can be 1,000, that number can be 10,000. It's immaterial. MRF at 60, 80,000, 90,000 rupees is not an expensive stock versus Reliance at 2,500. It doesn't work that way. So because what happens is your company today, you will decide to issue shares. And when you decide to issue shares, there are two variables, right? One is the number of shares that are outstanding. So it is my choice. I can say that I will issue or I will have in my company, I will have 10,000 shares or I will have 40,000 shares. And if I have 40,000 shares, the stock price will be 1/4 of what it will be if I have 10,000 shares. So what is important is not price. What is important is the value of the company, which is captured on market capitalization. So if you look at any app that you use, it will also give you a market cap number. That is basically what is the value of the company. The stock price is not the value of the company. It doesn't matter what the stock price is. Stock price is immaterial. I think the part that I want to also touch upon is you need to, obviously, if you want to do direct stock investing, you need to have some basic knowledge. I don't think it is too much of an effort to acquire that knowledge, but obviously you need to do some work. You need to understand what financial statements are. You need to understand and read those financial statements. Then you have to also, over a period of time, analyze different businesses because each business is very different. A services company, like an IT services company, right? They are completely different than, for example, an auto company, because auto company has huge plants, right? And they have a distribution network, and an IT company is pure services company. There is no plant, there is a small office, and all the costs are employee costs. If you look at metals are what happens to the metal prices in India is determined by what happens in China. So the drivers of that business are very different. If you look at pharma is a global business. You have to understand what is happening in India. You have to understand what is happening in the US. You have to understanding what is happening in other markets. So every sector is different, and every sector drivers are different. So you can't say that what thing you look at in an IT company are the same things you look at in a steel company, or what things you will look at in a pharma company. They're very different, and over a period of time, you will need to understand the basic drivers of each business. So don't get overwhelmed. I think you should start with some easy to understand businesses, right? Where IT services is very easy business. There will be a lot of you will get jobs in IT services. You will have friends who are working in IT services. You know there is an office, and you know there are people, and their people are paid this kind of salary, and that is their billing rate. So that is what you charge to your clients, etc. So you can understand that business much better because it's a very simple business to understand. Consumer businesses, for example, someone who sells washing machine or ACs or kitchen appliances, that's a very easy business to understand. Someone like a Hindustan Unilever, something like a Nestle, they are easier business to understand. You have to follow companies, understand sectors, and if you buy a stock, make a point that every 3 months when results come, you just understand, you see the results once. Most of the companies also put up presentation or do con calls, which are easily available on the websites of NSE or BSE. Try and also, for some stocks that you buy, try and see and track the results, try and see the investor presentation once in a while, try and read their con call details. You will start to understand what is the business over a period of time. This is a slow learning process. You can't learn everything at one go, and you will keep learning every day. So very simply, my 2 cents to all you young people is that investing is like poker. I think I'm assuming most of you play poker. I do. And just like poker is a game of skill and luck, right? And investing, to me, is very similar to poker in terms of there is an element of risk, skill, and there is a huge element of luck as well. And I think just like poker, you have to understand when the odds are in your favor, right? You play the cards. If you have pocket aces, you can still lose, but you know that if you have pocket aces, you will bet big versus playing with 2-5, right? In stocks also, there are opportunities where you think you can still lose from there, but there are opportunities where you think the odds are really in your favor, and you have to understand and play accordingly. And don't go overboard initially with direct investing in stocks, okay? Because you don't understand, and you will make mistakes. Making mistakes is good, but maybe initially do a lot of mutual funds and index funds and ETFs. I'll quickly talk about them as well. Maybe a good route is a very systematic plan. Every month from your savings, you decide that this part of the money I will put in an SIP, so that over a period of time, over the next 5, 7, 10 years, you will keep investing, and you will On some of those levels, you will lose. Some of those levels, you make money. So over a period of time, it just averages out. We are all engineers. We understand what averaging out is, and you average out over a long period of time. Read books, investing books in general. Read about companies. If you look at biographies of Steve Jobs or Amazon, you will understand how businesses work. I think it is important that you learn the ropes with small capital, right? You can't right now. You will feel bad when you lose money, but I think this will not hurt you. 10 years from now, you will think back and realize that losing 1 lakh or 2 lakh rupees doesn't matter in the longer run. So try and learn and lose money early, because everyone loses money. Everyone will lose money. It is better to learn early with smaller capital, and then you will become a better investor when you have more capital to invest. Okay. Please do not buy any stock based on what someone is telling on Twitter or WhatsApp. Please don't do it. Okay. Though no one knows anything, no one is an expert, no one knows anything. No one knew in February that COVID will happen. No one knew the market will go up like that. Most of these guys are looking for followers. Most of these guys are probably have their own interest because they have bought the stock and they are asking a lot of other people to buy it, so the stock price goes up and they will sell. Use your own discretion, okay, or otherwise go and invest with mutual funds or index funds or ETFs. Very quickly, in the next 5 minutes, I'll wrap up. So there are obviously 3 options for everyone who wants to do passive investing. One is mutual fund. Mutual fund is simple. There is a fund manager whose full-time job is to invest, and so they will create a pool. So everyone will pool in. You will have money, and that pool will be given to the fund manager to invest. So the fund manager will make individual stock choices. You will not make, and then you will have to see. You have to believe that the fund manager is smart enough to make the right choices for you. Mutual funds can be equity, they can be debt, they can be a combination of all of them. You have all those choices. You can also do large cap, mid cap, small cap. ETF is almost like a mutual fund and a stock. So it's a mutual fund that gets traded on the stock. You can trade just like a stock. You can trade the ETF, but ETF is not a stock. It is again like the example of index. It is a pool of security. The market for ETFs is shallow right now. Not too many ETFs are there in India. If you look at the US has thousands of ETFs, and my sense is that over the next 5-7 years, you will have lots of choices in ETFs. The market will explode with ETFs. Then, to me, the most easiest thing is index funds. And what are index funds is basically, like I told you about index. So people will launch Nifty index fund where the fund manager will just buy Nifty and the same ratio. So the Nifty moves up and down, your portfolio will move that much up and down. So if the Nifty over a period of time has given 15% return, your portfolio gives 15% return. It will just mimic the index. And because it is just going to mimic the interest, the index and the fund manager is not using too much of his own discretion, the cost of index funds are very low. And to me, the index fund most of the time will beat mutual funds because the costs are very low. And ultimately, a mutual fund will charge you 1%, 2% every year. And over a long period of time, that difference of 80, 90 points of 1% is good enough for index fund to perform as well as mutual funds. Okay. 2 other things I want you to tell you not to do. One is please don't do any day trading, and please don't do any derivatives. So no one in this world know what will happen to a stock in the short run. Absolutely zero way to know what will happen to a stock on any day. It's random. It's complete Brownian motion, right? You all have learned Brownian motion. It's pure random Brownian motion. So day traders are basically people who will every day buy or sell a stock. To me, 95% of them lose money. 95% of them lose money. 5% may make some money. But for you to make money and you be in that 5%, you have to be on the screen, glued to the screen 24 hours a day till the markets are open. Because you are playing small movements in the stock, right? You are not playing for long movements. You are playing for short movements. And you can't go out of your desk because you are playing for those short movements and things can happen. So most of these guys will have algorithms that help them trade. A lot of them are systematic algorithmic traders. Don't do day trading, especially when you get into jobs. There is absolutely no way you will make money by day trading in jobs. Don't do while you are in your college also. Other thing is stay away from derivatives, right? It's very lucrative because you get leverage, right? Instead of buying a stock for 100 rupees, you can buy the same stock by putting 30 rupees. It's great when you make money. When the stock becomes 100 to 120, your 30 becomes 50, right? It's great. And imagine what will happen when that 100 becomes 80. Your 30 will become 0. Again, because it's a levered play, people who are not so well versed, people who do not have good risk management, please stay away from any kind of derivative, either options or F&Os. Please don't do that. Do mutual funds, ETFs, index funds, do a little bit of stocks, good quality companies, and track them. And be ready to take losses. Please do not do day trading and derivatives. There's a final slide. Some books that can help you start off with. The psychology of money is a new book from Warren Buffett. It doesn't talk about any stock. It just talks about how you should think about building your capital, your money, etc. If you want a little bit of technical, I strongly recommend this Mastering the Market Cycle by Howard Marks. A very simple read. It will tell you how everything in market keeps going up and down, and everything that keeps going up, at that point in time, it looks that it will only go up, but it comes down. And when it comes down, you feel that it will never go up, but it goes up. Everything in life is cyclical, right? Interest rate cyclical. There was a time when there was 12% interest rate. There is 6% interest rate now. It will go again to 8-9%. Then Security Analysis and Intelligent Investor are basically books written by Warren Buffett's guru, right, Benjamin Graham. If you want to track generally what is happening, Screener.in is a very good website, excellent website. Okay, there is a free version and there is a paid version. You can use the free version. You can track all companies' results, whatever. They brilliant website, Screen.in. Otherwise, NSE and BSE India, you can go to any stock and look at whatever is filings the company has done, whatever the company has told its investors, everything is available. If you want to read con call details or listen to them, then Research Bytes is a good website. So all of them are free. You can use them. Please use them as much as possible. Learn and be ready to lose capital. You will lose capital. There is no way you will not lose capital. Just accept it. Thank you so much. I don't know whether it was useful. I don't know how I covered it, but that is in short what I wanted to cover in whatever 50 minutes. Thank you so much. Happy to take any questions.
Thank you, sir. It was a marvelous presentation. Now we will go ahead and take some time for the questions. Guys, please be sure to put your questions in the Zoom group chat.
Sir, there's a question from one of our viewers. Sir, how to analyze the sector of the stock I am willing to invest in?
I think it's going to. So I think the most important thing is you pick up any company. For example, if you want to understand IT companies, right? Infosys, TCS. You basically read any. So Research Bytes will also have reports. All these companies also upload their corporate presentation. They also upload their quarterly investor presentation, right? You look at the annual reports. So it's a hard work. You will not learn. You can only learn by either talking to people who have worked in that industry, right? Or you talk to someone who understands the industry very well, or you will have to go through the grind and learning it by yourself, right? To me, for example, try to start from a simpler business, right? So any of you guys, when you take up an IT job, or so I'm sure some of your friends are there, they will help you understand how the business works. And once you understand how that business works, you can look at the annual report or look at the presentation and understand what are the different cost items, what are different, how the money they make, what are onshoring, what is offshoring. It will take you some time, but by reading, you will know. You will understand over a period of time. You will never understand initially, but once you understand, you like it, you put some small money in it. Okay, don't put very small money. Put money that hurts you. You put money that if you don't make money, you make losses, it hurts you. Unless you will hurts you, you will never learn. Put money, let it hurt you, then you follow. And once you follow 4, 5, 6 months, 1 year, you will become better. There is no other way. There is no simple. See, Google also gives you can general search and do some Google searching. It will probably get you a little up to speed. But there is no substitute for learning it by self. And you have to put money and you have to lose money. Otherwise, you will not learn.
So to add on this, I would like to ask a question that Indian media has lost its trust nowadays. So to which media sources to follow, like the daily news, like which newspaper, which news channel to follow?
See, I'll tell you one interesting thing, right? Most of these media, the guys working in CNBC or ET now, they are not very smart people. When I say smart, they are not smart investors. Okay, they are anchors. They are not investors. They are anchors, right? There is a big difference. And the people who are in the research team are obviously not as smart as most of the investors that you will meet in life. And hopefully, you will become a much better investor than what the research team is. So you always remember that if you follow CNBC and you buy and sell based on CNBC, you will never make money in the long run. You may make money in one or two stocks, you will never, because people who understand the sector well, they will know what is happening before it comes on CNBC. So I think when you look at CNBC or look at ET or you look at Mint, right? So there are two parts to it, right? One is the analysis, right? When they talk about the sector or they talk about what regulation changes are happening and all, that is very good. So you can follow any of the newspaper, right? ET or Mint or Business Standard, whatever. Mostly to understand things that are happening in the larger economy, right? Where what is inflation happening on inflation, what is RBI doing, what is government doing, what is happening on interest rates, if there is a regulation, like the PLI scheme that everyone is talking about, etc. It will help you understand, right? And then there is a news part. Okay, the news part is okay. This is happening and this happened in Vodafone. Vodafone has increased its rates, etc., etc. I think that part is not important. That part is news. I think you have to understand what is news and what is analysis. Focus on the analysis. News part, it's fine, you can read it, but it doesn't matter. And don't follow news. Try to understand and analyze.
Okay, sir. Sir, in what manner should we go about investing when we don't have a proper cash inflow right now, as we are in college?
It doesn't matter. See, whenever you have some saving from wherever, you put that money in. It doesn't matter whether you are able to invest every month or whether you are able to invest when you have some capital. The key thing is whatever you invest. See, whatever you invest now, I can assure you the odds are not in your favor at this point in time. Okay. But whatever you invest today will also make you money probably in 10 years' time. It will not make you money in the next 5 years, maybe. So, one is when obviously when everything is going up, try to be a little more cautious. When things are going down, at that point in time, you can become a little bolder. But the point is that whatever you invest, if you invest with a longer period of time in mind, you will probably end up beating fixed income returns or FD returns anyways in the market. So whenever you get capital, you invest and go from there.
Yes, sir. Sir, how to find the undervalued stocks?
That I can't teach you in a session here how to find. I think finally it all comes down to you will find undervalued stock if only when you understand that value, right? And when you how do you understand that value is when you understand that sector. So again, it goes back to, for example, consumer company, right? If there is a small consumer, there is a so few things, right? See, one is a large company will never be undervalued. Let us be very clear, okay? Because what will happen is it is tracked by so many people. There are so many investors in that stock. It will never be undervalued. What will happen in a large company is you buy when the company you make money when the company does better than what everyone else expects it to. Okay, so for example, post COVID, no one thought that kitchen appliances sales will go up. What is happening is people spend more and more time at home, so more food is being made at home, more utensils are bought, so everyone is upgrading their kitchen utensils. No one during COVID thought kitchen appliances companies like TTK or Butterfly or Stovekraft will do so well. So one is no, they did better than what the market expected or general investors expected. You make money, or you get into those companies which are not on the radar, and that is basically going to happen when the companies are a little smaller. I'm not saying buy companies which are very very small, but even companies where mutual funds and large investors are not invested, because all these funds are large. They will not be able to get into a company where for example, the value of the company or market cap of the company is maybe less than 500 crore to 1,000 crores. That is where you can find undervalued companies. You will never find an undervalued company in a 20,000 crore market company. There, something different than what, if your understanding of the sector is superior to the general investor, you can make money, more money, or you will get same 12-13% return in those companies. So either you understand the sector very well and you can see that this will do better than what others are thinking, or you go down and look at those stocks which are under the radar, which are not in the eyesight of mutual funds and FIs because those companies are still too small. But again, smaller the company, you have to also understand it better, because smaller the company, more the risk and more the volatility in that company, right? Because they will have, the business is smaller. If something happens, a COVID-like thing happens, it impacts them more than a large company. Their ability, resilience is lesser. So there are no easy way out here. But I think for people like you, you should have a mix. You should have some large caps, and you should also experiment with some sectors that you like and you're simple to understand sectors. Try and buy some relatively smaller companies and then see how it goes for you. You have to spread, and this is a learning phase. Don't be afraid of learning, and don't be afraid of losing some capital.
Sir, as you said, we shouldn't invest in real estate. So, sir, are REITs a good option?
So REITs are practically fixed income options. Yeah. So what happens is REITs are not real estate, residential real estate. They are commercial real estate. So they are office spaces. So Embassy, for example, makes office spaces and then leases it out. What it does is it makes a building, leases out to Goldman Sachs for 10 years or 20 years. So what it will do is it will tell investors that you give me upfront money, and it's like a 20-year instrument of perpetual instrument where every year what money I get from Goldman, I'll pay you. So you become practically a part owner of the office space. Okay. So it's a fixed income product. Don't expect equity-like returns in REITs. Probably the returns will be between stocks and debt, because what will happen is the money that Embassy makes, they will make new offices. Every year the rent also goes up by 5%, right? So there is going to be appreciation of income from Goldman and from new offices that will keep coming up. So there is a mixture of fixed returns and there is a mixture of upside of stocks. So REIT, in a very simple manner, is somewhere between debt and equity, but it is not pure equity. It will not have unlimited upside.
Okay, sir. And sir, sector-focused mutual funds versus small cases. Can you do a comparison?
So both are good. I don't think that's an issue. Small case to me is very similar to a mutual fund. It also gives you an ability to invest very small capital, which mutual fund also does. But small cases, the interesting part with small cases is that you get a lot more variety, because in mutual funds there is a lot of regulation from SEBI, and so there are certain categories of mutual fund that can be launched. A small case has a lot more flexibility. I can, for example, tomorrow I can launch a small case and say, okay, I will launch a small case only investing in kitchen appliances companies. There are only 4 of them, but I'm just giving you an example, right? So there is a lot of experimentation that is going on in small case. You have to understand what kind of small case you are looking to invest in. You also have to understand what are the risks associated with that. See, all of these guys will put back testing when you look at the small case, and small back testing is complete nonsense. Okay, any strategy that looks good on back testing may work completely different when you do live investing in those. But I think you should be open to both small case and mutual funds. I think small case is a good instrument. I am not doing small case. Small case is generally very good for very small investors, but be on the lookout for good small cases. I think both are good. I don't think any issue. Especially stuff like momentum, and I have not covered fundamental momentum because we didn't have that much time. But you will find a lot of small cases which are doing momentum and which are doing that kind of stuff that is not permissible or not done by too many mutual funds. So for simple equities, you can look at mutual funds, and for some stuff that is not being offered by mutual funds, you can look at small case.
So does following big investors really help?
So there are 2 things, right? It helps. It helps because it can get you thinking. So I normally don't buy what some big investor is buying. Okay, I'll tell you the reason for that. Because you will know when he's buying, you will never know when he's selling. So the problem is, if Rakesh Jhunjhunwala buys a stock and it comes in the newspaper, first of all, it will come in the newspaper after 3 months, because shareholding comes out. So you have to remember, shareholding comes out every 3 months, and also only shareholding of more than 1% will come out. So a Jhunjhunwala may be buying 6 months back at 100 rupees, and you will get to know when the stock is already 250. So that is one part. You have to understand. You will not know exactly when he is bought. Second thing is, when Jhunjhunwala sells, you will not know. You will not know. So the important part is, you should understand why he's buying. So the way I look at it is, whenever the big investor buys something, all these big investors are big investors because they are very smart, right? They're very smart. They've done very well. So you should think what is happening. Why is he buying this? Is this sector looking good? Is there something in this company? You should think, and then you should make your own decision. Because the big problem with all these investors is that you will not know exactly when they started buying, and you will never know when they sold. So and people make mistakes. See, Jhunjhunwala was invested in DHFL. Okay, don't forget that, and that money has become, that stock is delisted, right? He was also, I think, invested in Jet Airways in 50. So Jhunjhunwala has 15,000 crore value, right? He will. I buy 100 stocks. I don't make money in 40. I make money in 60. The point is that you will not know what are those 60s and what are those 40. So he may be putting, out of 15,000 crore of net worth, he may be putting 100 crores in a stock where he loses money. But he may be putting 5,000 crores in a stock that becomes a multi-bagger for him. So till you know what is his bet size, right, and how he's looking at risk, and whether it is a small bet for him. A 100 crore bet is a small bet for Akash Jain. You have to understand what he's trying to do. So it's not easy. Don't mimic, but definitely follow and understand why they are doing it.
Sir, Kevin has a demand, sir. Sir, can you do an analysis of a company like any stock, like a Tata Power stock, and tell whether it will go up or down in long run?
No. So in long run, sure. See, in long run, practically all stocks will go up. Okay, long run, because definition of long run, I don't know what is the definition of long run. So an Infosys in 2000 came at a price after which it did not make money for 7-8 years for anyone. But today in 2021, Infosys has made a lot of returns from even 2000 levels. Okay. So the point is that long run, what is the definition of long run? Long run is 5 years, 15 years, 20 years. So very simply put, if the industry is doing very well, okay, you will make money in it. The point is that if you are buying in the current times, the possibility of making good money over the next 5 years are much lower, versus when you have bought after some stock has corrected, or in the general market has corrected. So for a lot of people like you, I think if there is you will get to know, because as soon as the market comes down by 15-20%, all the newspapers and CNBC will start shouting that market has corrected, market has corrected. So you will know that now there is fear, because now everyone is saying the market can only go up. At that time, everyone will tell you the market can only go down. Okay. Most of you should start nibbling or buying companies when the correction happens. I don't know when will it happen. And it's possible that when you buy, the stock corrects even more from there. But your odds will be better. Okay. Right now, for you to, I can't analyze a company on a Zoom call very simply. It's not, that's a big session. Even if I pick up a very simple company, I'll probably take 1 hour to explain the basics to you. So I can't, in a Q&A session, I can't analyze a company. But in the long run, you will make money. You have to think of, you'll use some common sense, right? You see, okay, AC companies, right? You know that ACs today, 5-10% of the population is using AC, right? You can use your mind, and you say, when you guys come out, right? Your parents will not have ACs in their houses. When you move out and you start your job, you will probably, in the first year salary, you will put an AC. So you will know that over the long run, all AC companies should have a good trajectory. Now some will screw up and some will do very well. That you will have to understand. But I'm saying sector-wise, you can take some very broad calls. Cars, you know that only a small part of Indian people have cars. but over a period of time with more prosperity, everyone will buy cars, right? You look at print, right? You know, your father used to have his morning newspaper and chai. None of you will probably be reading newspapers in the morning, right? So you know that industry is going to decline. You should not put money in any print media. So a lot of common sense can be used, but it's not so, like I said, right, it's simple but not easy, right? So even something like an Infosys did not make you money for 8 years if you buy it at the wrong time. So one is how the company does. The company may do, so Infosys will do very well for the next 20 years, okay? But whether you as stock investor will make money for the next 5 years, that I can't tell you. That all depends on how the stock price goes. That depends on how the overall general global equity market scene is. It depends on what valuation you bought in. You bought it at 1,000 rupees, you bought it 2,000 rupees, you bought it 3,000 rupees.
So what are your views about newer markets like crypto and NFT?
I don't do it. I don't do it at all. Not because there's anything wrong in it. See, to be honest with you, I am obviously much older than you guys. My risk appetite is lesser. One thing I have understood, and that something you should also understand. You should experiment a little bit. I am not saying don't experiment, but only buy what you understand. When you don't understand, to me, I don't understand how crypto moves. I just don't understand. A stock, anything that can correct 50-60% in 1 month, right? And go up 50-60% in 1 month. I just don't understand. So maybe I will miss out on really big potential gains. But I do not have the mental aptitude right now, or I don't understand crypto well enough for me to take that kind of risk. If I do crypto, I'll probably do it with 2-3% of my net worth. Okay. You guys should experiment. I'm not saying do crypto, but be open to experimenting a little bit with NFTs and with crypto. But over a period of time, also try to understand what is happening there. Don't look at pure speculation, because what is happening now in crypto is pure. It is going up, so let me buy it. Why is it going up? Why? What is the logic of crypto? Why are people so bullish about crypto? Why does a particular crypto fall 60% because Elon Musk had put one tweet on crypto? What kind of nonsense is this? So my point is, remember, whatever you're putting in crypto can fall to 90% down, just like Amazon happened. And that can happen without any reason or rhyme or reason. It can go up also 100%. Be ready for that kind of volatility. So you put what you are ready to lose and experiment. I am not saying, I am not doing crypto. I am not going to advise you not to do it. You guys are young. You should experiment. Unless you experiment, how will you learn? But experimenting or putting large capital without understanding the nuances of what is happening, I think that's basically gambling. That's playing roulette. Don't play roulette. At least play poker. Roulette is pure luck, right? Zero skill, pure luck. Poker is at least some skill. So don't play roulette, play poker.
Okay. So should we be able to decode the candlestick pattern to begin investing?
So see, most of the fundamental investors will scorn at technicals, right? They'll say like this is complete nonsense, and you should look at Warren Buffett will scoff at technicals. He'll say like this is complete nonsense, right? I actually don't believe that. I think technicals have their own place, and fundamentals also have their own place. I personally, if you ask me, I am not into technical trading, but I have over a period of time started appreciating the fact that if you like something fundamentally, you should also look at how it looks technically. And the reason for that is there are so many things that you will never know. And I'll give you a live example, right? I was invested in pharma last year, right? I invested some capital in pharma companies. They did very well, excellently well. And this year, what has happened is because of last year's scenarios, a lot of end clients, because of COVID and supply chain uncertainties, they stocked up a lot on medicines. So when the US market stocks up on medicines, the Indian pharma company will have a blockbuster year because they will sell. What is happening this year is they have already stocked up, and now they see that there is no reason to buy more. So this year they've started buying less. And when they buy less, Indian companies' revenues get screwed. Okay. So most of the pharma companies' stocks have fallen significantly. Okay. Now, as an investor, it is not easy for me to really understand what is happening in a micro market or what is happening in a particular drug in the US or some other market. So I just use pharma as an example, but I'm saying there are a lot of things that even if you understand what is happening in the company, there are so many things completely beyond you which you will never understand. And there are always going to be smarter institutional investors who have the ability to understand better than you, right? Someone, a big fund or a mutual fund who has a research team of 50 people, he has resources to track these companies, he has resources to track what is happening in a particular molecule. He will know what is happening to ibuprofen sales in the US. He will be smarter than you in getting in and getting out. To me, as an individual investor, the stock price will tell me something is going on before it starts reflecting in fundamental numbers. So to me, if you ask me quite honestly, having some basic understanding of technicals adds to your ability to become a good investor. Sometimes in a smaller company, for example, one large investor for whatever reason wants to sell, the stock will still fall. But in a lot of cases, having some understanding of technicals will help you save your pants. So I think for you to start trading based on candlesticks, I think you need to really take a lot of time. It is not going to be easy because the patterns are not very easy to understand. But I think over a period of time, 6 months, 1 year, if you start using them to make some fundamental bets, I think then you over a period of time, it adds to your abilities. But for you to start trading on technicals, you need to really get very good at it. I'm not good at it personally. I don't trade purely based on technicals, but I definitely look at charts before I invest.
Okay, sir. Sir, probably the last question. Sir, is there any thumb rule that after a big rise or a fall in the market, there is always a sideways trend?
No. If there was a sideways, everyone thought that after COVID 2020, the market will go sideways. The market went V-shaped. There are no patterns here. There are certain patterns which repeat. But if everything, if it was so simple that every stock after a fall will go sideways, it was so simple, everyone will do the same, right? I will know whenever there is a fall, I will know that the stock will not go up for a long time. So let me just sit and sell all that stock, and whenever it starts rising, I'll buy again. It is sometimes it happens, sometimes it doesn't happen. Because if it was so simple and it was always going to happen, then that arbitrage will go away. So anything which is a set pattern, right? Everything which is a set pattern, everything which is a set pattern becomes an arbitrage opportunity, right? You can make money of it. If every time the stock falls 50%, I know that there is going to be, for example, a 20% bounce. Then if it happens every time, then every time someone will buy at 40% down, 30% down, because they know the stock will rebound. There is no way to make sure money in the markets. You play probabilities. I think if the stock falls 50%, the chances of it rebounding very strongly immediately is low. But it's not that it doesn't happen. It also depends on why the stock has fallen. If the stock has fallen because some investor is selling and there is not much demand for that stock, as soon as the selling goes, the stock will rebound strongly. Okay, but if the stock is falling because the industry is going through a downturn, like what I am seeing in pharma today, maybe for the next few quarters, I personally, my take is that we will not have a strong rebound immediately. So there will be a consolidation. So it all depends. It's not so simple, and it is not a set pattern anywhere, because if it's a set pattern, then people will take advantage of the set pattern, right? If every time the stock breaks out, for example, and it goes 20% higher, everyone will jump in when it is breaking out, and the stock itself, that day itself will go up. There is always, remember, there are certain patterns which repeat, but there are a lot of patterns which will never, because the reasons for a fall or a rise you will never know, and you will not know what is happening in the individual stock in terms of demand and supply. See, the company Infosys performance between 2000 and 2021, you will not see too much variation, but stock price you will see a lot of variation. So finally, the stock price is determined by what price Abhishek is wanting to sell, or how desperate he is to sell, and at what price Akash Jain is ready to buy. So what happens is, when the stock or market is falling or stock price is falling, I will need no hurry to buy, because it is falling. I will say, let me just wait now. What's the hurry? The stock is anyways falling. And Abhishek, who is a seller, will be desperate because he says the stock is falling. I want to get out as soon as possible. So there will be more pressure of sellers than buyers. And that is why typically the stock will fall more and all the buyers will stay away. And so the stock will fall more than what it should. After a point in time when all Abhishek desperate selling is getting over, then people will start saying, okay, the pressure on selling has gone over. Then you see, now there is a lot of value in the stock, then everyone will jump in and then the stock will go up or go sideways or whatever. So I think when you look at these patterns, one is obviously how the price is moved. Another thing is the most important thing is obviously look at volumes. Volumes tells you a lot. If there is a stock is falling on very high volumes, that means a big seller is selling. And when a big seller is selling, you know the price will go, chances are it will go down more unless an equally big buyer comes in. So most of these chart patterns look at not just charts, but they also not just look at candles, but they also look at volumes. Even after so many years, I don't have the confidence to do candles or technicals myself. But I think if you want to get into that, it's a completely new sphere of investing, and it takes a lot of time. And the discipline required in technicals is even more than the discipline required in investing, in fundamental based investing. Infosys, I know that I like the company in the long run. For example, if I don't make money in 1 or 2 years, I am okay, and I have confidence enough to say, okay, if the stock falls at 20%, I am still okay to hold because I feel that it will go up, or my hope is that it will go up eventually. In technicals, if you start doing that, you will lose your pants. You need to work with very strict stop losses and understand what is right pattern, what is not pattern. Most of the traders will have a ratio of 55% to 45%. Most of them. So 55% of the trades will probably not work, and 45% will work. So that if you do 10 trades, you will lose money in 6 of them probably. But the key thing is how much you make when you win and how much you lose when you lose. That is the important part. That's how you make money. So experiment, but don't go overboard. In anything, don't go overboard. This is a time for you. You guys for the next 5 years should experiment, should be happy to lose capital. Unless you lose capital, you will never learn.
Just a gentle reminder to the viewers, please fill the feedback form before leaving so that you can claim your certificates. So one more question, something about invoice discounting.
How is that relevant for this session?
Someone has mentioned in the chat box. So I was just...
Invoice discount, no company does invoice discounting as a pure business. So invoice discounting is, for example, today you let's go back to the example of the shop, right? And you know that your friends are going to pay you in 7 days, okay? But you need money today. You will come to Akash Jain and you basically say that my friends are very good. They will never default. They will all pay what their dues is. So I have 3 lakh rupees that I need to get from them. Can you give it 2.5 now, for example, right? And give that, and once that 3 comes, I will give you those 3. So I basically get for the risk I take of default of your friends, I make that 50,000 rupees, right? But you get your money today instead of getting in 7 days. So that is what bill discounting is. You basically go with your invoice, your bill, that this money is due to me in this point in time, and this customer is a very good customer. He will pay me in 60 days. Don't worry. I will look at the invoice and I will make my own assessment whether this customer is good or not. My risk and my understanding of that customer's credit worthiness, right? And accordingly, I will discount it. So that is basically what invoice discounting is. Banks do it. A lot of businesses are doing it now, where they are trying to get cash earlier. So, for example, if they are a distributor or a Flipkart, for example, if you are selling your products on Flipkart is to pay you in 30 days. You will go to a bank or an NBFC and tell them that, boss, this Flipkart will not default. They owe me. I have already sold. This is the invoice. They are going to pay me in 30 days. Can you give me now? Instead of 1 crore rupees I need from them, can you give me 95 lakhs today? And people will say, okay, Flipkart, I am ready to take a risk. Amazon, I am ready to take a risk. I am going to do it. But tomorrow, if you go and say Infibeam, I have to get 1 crore rupees from Infibeam. I'm just taking names. Don't take it literally. I may say that, okay, I am not as confident about Infibeam, so I will either not discount it for you. I will say, yeah, boss, I am not going to give you 95,000 lakh rupees, I will give you 80 lakh rupees because I want higher returns for the risk I am taking. So a lot of banks and NBFCs do bill discounting. A lot of businesses are now doing bill discounting to get money faster so that they can churn and use that capital somewhere. That is what bill discounting is.
Sir, just one last, my own personal doubt. Sir, like gold is like a good, what kind of role gold investments play in our portfolio? Like, is it a good, does it provide cushion or is it a good investment for long run?
It depends. It does both. Okay. So over a long period of time, see, the problem with gold is that there are a lot of moving parts, right? Gold is typically dollar denominated, right? Everyone talks about gold $1,800, $2,000, $1,000. So what price you get is basically the risk you are taking is one is the gold price in dollars, and the second risk you are taking is how does the rupee move with dollar. Right? Today rupee is 75, tomorrow rupee may be 70, or the tomorrow day after tomorrow the rupee will be 80. And over a period of time, right? So your returns or the Indian INR price of gold is basically the US price of gold into the exchange rate. Okay, so when you invest in gold in India, typically over a period of time, Indian currency is depreciating. Right? Today it is 75, tomorrow it will be 77, tomorrow it will be 80. Okay, so that's a positive for price of gold because every time that 1,000 rupees will give you 75,000 today, 80,000. You understood what I'm saying? So one is
I will get more gold for the same price.
you will get more money for the same gold.
Yes, sir.
If you have some gold, you can sell 1 year later because the gold price may remain $1,000, but because currency has become 76, the rupee price will go up by 5-6%. Okay, over a long period of time, gold has basically done two things, right? Where if it is there is a lot of inflation, you say you assume that gold will basically is a hedge against inflation. So it's not something that will give you extraordinary returns. Okay. But in India, for example, you can assume that over a period of time, gold will probably make you 7-8% return. Okay, because of currency and because of inflation. Long period of time. But what also happens in between is if there is huge uncertainty, right? Huge uncertainty, then you know that gold price will not be as volatile as the price of stocks, etc. So whenever there is a huge volatility, uncertainty, a lot of money flows into gold. And when there is a lot of certainty and everyone is very positive about what is happening around, you are bullish and stocks are going up, typically you will see gold not doing well because no one wants to invest in something which is going to give him 5-6% return, right? Everyone wants 20% return daily. So it's a hedge as well as it saves you from significant uncertainty. To me, you should probably invest 4-5% of your net worth in gold. You will realize that over 5-6 years you would have made zero returns, but then in 2 years you will make 50% returns, just like stocks. But 10 to 12% return in gold has happened. The other problem that I am now seeing in gold is because of this other asset classes like crypto and NFTs that have come up. A lot of people who want to invest outside of equities into something which are alternate assets, right? They are probably choosing bitcoins and NFTs, etc., which to me is possibly impacting the demand of gold. And that is why in the last 1.5 years, I would have expected gold to go up, but gold has actually gone down. So I don't know how this will play out, but I think I think some part of your net worth can be in gold, especially at a certainly late stage in life. Right now, you may or may not. It doesn't matter.
So we can summarize that like stock market is understanding the demand and supply forces, both of the stock market and outside. Like
yes, and understanding what is happening because lots of times for unforeseen events, things can happen. Completely unforeseen event. 9/11 happened in the US, right?
Yes, sir. So
yeah, so I'm saying 9/11 happened. Nothing happened to the business. Nothing happened like that. But suddenly there is an event where no one had any control over, in the stock market crashed. So lots of things in between can happen. COVID happened, right? No one had any idea what COVID will happen. there can be a regime change, right? Modi may lose, and I don't know how the market will react to it, etc., etc. But the whole point is that in the short run, there are certain things you can predict, and there are a lot of things that you can't predict. And I think over a period of time, the things that you cannot predict are becoming more and more, because the world is becoming more interconnected. So what is if the Fed or the US Fed, which is the central bank of the US, if they do something, it impacts Indian markets more than what RBI does. And it is not easy for an investor to really know what is happening in the US, what is Fed thinking, what is the fiscal situation in the US. And also, to me, investing every year is becoming easier and harder. Easier because there are a lot of information that is available, but harder because how much can you practically read? So you have to evolve. I think, to me, investing is becoming more and more difficult with time. But if you are smarter and you understand what is important, what is not important, you figure out a way, you can do really well.
Thank you, sir. So it looked like we have covered all the questions.
Thank you so much. Hope it was useful.
Thank you, sir. It was great to host you in today's Android Club event, and we would like to thank you for sparing your valuable time with us. We will see you in upcoming events.
Thank you so much. Bye-bye.
Thank you, sir, for your valuable time. It was really insightful.
Thank you.
Thank you, sir.
Just a gentle reminder, please fill the feedback forms to claim your certificates. I would be waiting for 3 minutes more, and then we would be ending the session. So you can please open the feedback forms.